Good evening, everyone, and welcome. I am Divya Gopalakrishnan, and on behalf of CareEdge, I welcome you to our today's discussion on At the Cusp of Inflection Power Financing set for 15% growth in FY25. We sincerely appreciate your time in joining us for this webinar. We would like to welcome our esteemed guest speakers for today. Ms. Monika Kalia, Deputy Managing Director, Chief Financial Officer, National Bank for Financing, Infrastructure and Development. Ms. Charu Kaistha, Chief General Manager, Power Finance Corporation Limited. Mr. Ankit Patel, Senior Vice President and Head, Credit Research, HSBC Mutual Fund. This session will be moderated by Sanjay Agarwal, Senior Director, CareEdge Ratings. We will commence this session with a presentation by Neha Kadiyan, Associate Director, CareEdge Ratings. This will be followed by a panel discussion and a Q&A session. In case of queries, participants are requested to key in their panel. We will take up the queries during our panel discussion. Now, may I invite Ms. Neha to make her presentation, please?
Thank you, Divya. Good evening, everyone. I'm Neha Kadiyan, Associate Director at CareEdge, and today I'll discuss about the current ongoing trends in power financing space and outlook going forward. The key takeaways from this presentation are rising power demand will initiate substantial capacity addition requiring significant debt investment of around 24 lakh crore till financial year 30. Power-focused IFCs, with their improving balance sheets, are well positioned to finance this growth with rising allocation towards the renewable sector. While banks' exposure to power sector has largely remained range-bound, healthy loan book growth has led power-focused IFCs to continuously gain market share. Power-focused IFCs are expected to report robust profitability metrics with a return on total assets of 2.7% in financial year 25. With recent RBI regulation, share of bank borrowings may moderate in overall liability profile. Though operating environment remains favorable, client and sector concentration, technology transition towards renewable, rising exposure towards the private sector, macroeconomic uncertainties, and high competition from banks and other FIs remain the key monitorables. We'll start with what is the incremental fund requirement considering the planned capacity addition. As can be seen from the left-hand graph, India had an installed power capacity of 437 gigawatts as of March 31, 2023. The same comprised fossil fuel-based capacity of 246 gigawatt and others at 191 gigawatt. Going forward, we expect the non-fossil capacity to increase in a phased manner and reach around 450 gigawatts by financial year 30, while assuming the energy demand to grow at a CAGR of 6%. This will, in turn, require significant debt investment of around 24 lakh crore till financial year 30. Of this, sizable 17.5 lakh crore is expected to be coming from the generation. If we go further, around 80% of this generation investment is expected to come from the renewable sector. Power-focused IFCs with their improved financial profile are well positioned to finance this expected growth. Also, these companies inherently have an upper edge basis their ability to give long-term loans and adequate domain knowledge and technical expertise. Moving towards the growth outlook, while the left-hand graph shows a disbursement trend, graph on the right side shows outstanding loan book. COVID-19 led to a decline in the capital expenditure plan and subsequent delay in disbursements, resulting in the loan growth moderating to 2% year-on-year in financial year 22. However, growth rebounded in financial year 23, led by increased funding to DISCOM and renewables. We expect the trend to continue and disbursements to reach 2.9 lakh crore in financial year 24, resulting in healthy loan growth of 16% year-on-year for financial year 24. Coming to the loan portfolio mix, graph on the left-hand side shows share of loan portfolio of power-focused IFCs towards various segments. Traditionally, the loan portfolios have been dominated by the generation sector. However, supported by government schemes, the share of distribution loans has gradually increased over the past few years. Also, the share of renewables, though modest, has gradually increased and is expected to rise to 14% by financial year 24 and further to 21% by financial year 25. In terms of private-public mix, as visible from the graph on the right, currently, majority exposure of power-focused IFCs is linked towards government sector. These loans traditionally have low default rates, with loans to the government sector being well diversified across various state and central government. However, with the anticipated rise in exposure to renewable sector, share of private players is expected to gradually increase. This shift could potentially elevate portfolio vulnerability. However, we note that majority of the private sector exposure is backed by robust balance sheet and secure power purchase agreements. Now we'll discuss about the competitive landscape. While banks' exposure to the power sector has remained relatively range-bound, growing by marginal 1% year-on-year over the past 7 years, power-focused IFCs have experienced consistent growth in their loan book, growing at an average of 10% year-on-year over the past 7 years. This consequently led to a shift in the share of power sector funding towards these IFCs. As can be seen from the table below the left graph, share of power-focused IFCs has increased from 44% as on March 16 to 59% as on March 23. In terms of overall loan book of NBFC IFCs and IDFs, power-focused IFCs comprise 64% of the total loan book. This substantial share underscores the pivotal role these institutions play in financing infrastructure projects. Coming to financial metrics, the asset quality metrics for power-focused IFCs have shown continuous improvement, primarily to negligible loan slippages and recoveries from legacy accounts. This improvement has been further supported by various initiatives launched by Government of India, which have substantially reduced the legacy dues of generation and transmission companies. This, along with the rapid resolution of assets, has also played a significant role in recoveries from stressed accounts. Going forward, power-focused IFCs are expected to maintain their asset quality largely under control. In terms of profitability, there has been a consistent upward trend, largely attributable to a decrease in credit costs. The return on total assets improved to 2.6% in financial year 23 and is expected to further rise to 2.8% in financial year 24. While power-focused IFCs typically have moderate net interest margins in the range of 3 to 4%, their wholesale-driven business model leads to low operating expenses. Coupled with the improving trend in asset quality, credit costs have been effectively managed. This has enabled power-focused IFCs to report strong profitability metrics. Adequate capitalization profile. While low disbursement supported the improvement in the gearing profile in financial year 22, healthy internal accruals helped to keep the gearing under control in financial year 23 and financial year 24. Going forward, the capital structure of these entities is expected to remain range-bound, with projected healthy internal accruals. Coming to the liability side, in the past, power-focused IFCs have traditionally relied heavily on market instruments for their borrowing needs. However, there has been a shift in recent years towards a greater reliance on borrowings from banks and financial institutions, likely due to the pricing differential. Borrowings from banks and FI increased from 27% of the borrowing profile as on March 19 to around 44% as on September 23. This trend aligns with the broader increase of banks' exposure to NBFCs. The proportion of banks advanced to NBFCs has almost doubled over the past 5 years. Power-focused IFCs account for a substantial quarter of the total banking sector exposure, as visible from the graph on the right. Going forward, the pace of growth in bank borrowings may moderate in the light of the recent directive issued by the Reserve Bank of India. The RBI has mandated an increase in risk weight for bank loans to NBFCs with ratings between AAA and A by 25%. This is likely to result in a negative price differential in the near term. Now, we'll discuss about the key risk factors impacting the sector. The power sector is poised for substantial capital expenditure, bolstered by various GOI reforms and improving balance sheets, leading to a favorable growth outlook for these entities. However, there are potential risks which need to be closely monitored. Power-focused IFCs face exposure to sector concentration since they mainly cater to the power sector. Also, higher ticket size lending can lead to a sizable client concentration risk. Power-focused IFCs are also influenced by macroeconomic factors like GDP growth, inflation rate, currency fluctuations, and interest rates. Economic downturns can lead to reduced energy demand and decreased investment for infrastructure projects. Fluctuation in the commodity prices can also impact operating cost and profit margin for the clients of power-focused IFCs. Further, the ongoing shift towards renewable energy sources will increase the share of private borrowers in the lending mix, which may increase the portfolio vulnerability in the medium to long term. Also, the shift towards newer areas of renewable energy implies continuous technological innovation. Power IFCs need to adapt and evolve their underwriting models to keep pace with the changing landscape. High competition from banks and other FIs may negatively impact growth and lending spreads. This emphasizes the need for effective strategies to maintain competitiveness in the market. In a nutshell, growth momentum is expected to continue, with power-focused IFCs expected to grow by 15% year-on-year in financial year 25. With increasing disbursement towards renewable sector, share of renewable energy is expected to increase to 21% by financial year 25. The profitability profile is anticipated to remain robust with a ROTA of 2.7% in financial year 25. Healthy profitability, in turn, is expected to keep capitalization profile range-bound. Client and sector concentration, competition from banks FIs, increased exposure towards the private sector, macroeconomic uncertainties, and technological transition remain the key monitorables. That's all from my side. Thank you.
Thank you, Neha. As conveyed earlier, all attendees are requested to key in their questions, which we will take up during our panel discussion. Now, may I invite Sanjay to take over the session, please? Sanjay Agarwal is a senior director at CareEdge Ratings. He has 3 decades of experience in the field of ratings, banking, and infrastructure finance. Currently, Sanjay is heading the BFSI vertical of CareEdge Ratings. Prior to joining CareEdge, he has worked at ICICI Bank and IFCI. He has a bachelor's degree in commerce and is a chartered accountant. He is also qualified as a grad CWA, a financial risk manager from GARP, USA, and as a certified financial planner from FPSB India. Over to you, Sanjay sir.
Thanks, Divya. To start with, I'd like to introduce the panelists. So can we have those introductions, please? So Monika Kalia, she's the Deputy Managing Director of NaBFID and also the CFO of that organization. She's previously worked with as an ED with Bank of India, where she's handled various roles. Prior to that, she's worked extensively with Union Bank of India. Besides being a rank holder BCom, she's also a fellow member of the Institute of Company Secretaries of India, as well as a certified associate of the Indian Institute of Bankers. Let me introduce Charu Kaistha to you. She is the Chief General Manager, Project Division of Power Finance Corporation Limited. Charu currently holds the position of Chief General Manager at the Project Division. She has 20 years plus years of cross-functional exposure at PFC, both at the asset and the liability side. Presently, her team is focused on energy transition projects as electric vehicle, pump storage, green hydrogen, etc. She holds the MBA degree from in finance from Faculty of Management Studies, Delhi, University of Delhi. Our third panelist today is Ankit Patel, who is the Senior VP and Head of Credit Research in HSBC Mutual Fund. Ankit has experience across sectors of oil, gas, power, infrastructure, manufacturing, etc. He holds an MBA in finance from the Narsimoni Institute of Management Studies and has a BTech in electronics and communication from Motilal Nehru National Institute of Technology. We welcome all the three panelists and look forward to a very fruitful and engaging discussion. So I'll start with my queries first. So the first query is for Charu. So how do you see the share of power IFC moving as compared to banks in terms of the overall funding for the sector? Because we've seen that in the past 7, 8 years, it's moved pretty dramatically. So how do you see it going forward? You are on mute, Charu, right now.
So power is our, core area of financing. And PFC, as you know, has over the last 40 years grown from, a fledgling or a nascent organization to a Maharatna public sector unit. So we will continue with our growth path. This is what I can say.
Okay, and in terms of banks, do you think the competitiveness of market share to remain as it is right now, or do you think some movement out there?
Firstly, I think it's very great to have competition. It's actually useful because we learn from each other. And in banking loans, you also have a consortium loan approach where you can be a lead lender or you can also join the consortium. And there's a lot of refinancing also happening. So it's a very beautiful scenario. I mean, honestly, I don't see any concern at all. It's a growing sector. Power sector has growing demand. Power sector also has, growth through various schemes of the government of India. So you have growth which is coming in, at least for PFC, from the LPS, which is one scheme for the distribution, and RDSS also. And then you also have your solar mission, and the solar mission has been rolling out since 2010 and it will continue to roll out till 2030. And in that we look at 50 gigawatt capacity addition per year. I mean, there's a whole lot of growth drivers. I mean, if you can ask a more specific question, maybe I can try to answer that, or I hope this answers what you asked.
Okay, so I'll move to the other panelists before we come back to you on probably a more specific sort of a question. So Ankit, what do you think are the key areas which differentiate the power-focused IFCs vis-a-vis banks?
Yeah. Yeah. Hi. Thanks, Sanjay. It's a tough, I mean, it's a tough question for me actually to start with, but I'll try and take it. So I think what differentiates specifically is obviously their focus. Number one, they are specifically for the purpose of power financing. They have developed so their standards, their people, their way of thinking is primarily power focused, and hence it allows them to basically completely zero in on only that sector. Number one. Secondly, I also feel that in terms of how it has changed over the years, I think they were always constituted for this specific purpose. But what has changed in the last 4 to 5 years, especially, is obviously their ability to also raise financing abroad as well as from other channels, and also the focus that the government has put in terms of how these entities are to play a role. Often it is the government sets up various vehicles in order to achieve the goals that have been set out. And at times these vehicles are given a lot of funding is just one part of it, but in terms of the onus given to them in terms of going ahead and basically taking care of some of the government schemes. If you look at whether it is the RDSS or it is even the LPS scheme, and the various activities that PFC has been doing in the past. For example, the annual rating exercise of discoms, or various ways in which PFC tries to basically judge how they are performing, and PFC also sets different guidelines and different requirements for various generating or discom entities. to access that financing, because that financing is easy and available in bulk from PFC. So I think at various stages, uh, PFC, by way of its continuous interaction, has some edge. But at the same time, I think banks also continue to be financiers. Uh, it is just that in the last 3-4 years, I think both of these large, power financiers have really pushed it in terms of their own presence within the power sector, and the presentation also showed that.
Yeah,
Actually, I think I heard the question wrong. So anyhow, give me a chance afterwards.
yeah, no, you can take it right now. Yeah.
So yes, so the question, as I understand, is what are the key areas that differentiate power IFCs from banks? Is that the question?
No, that was to Ankit. So because
Oh,
you would
Acha,
be an
my question
interested,
was different
you
from
would be
Ankit,
an
but I want to
interested
answer
party
this
in that. Yeah.
question. See, what differentiates us from banks is that we often come under the concerned ministry. And because we are under the concerned ministry, we are part of the government missions, as you rightly pointed out. And we are also part of the government schemes. We roll out the schemes and we do a lot of policy advocacy for rationalization of policies. And, we also help a lot in favorable policy evolution which helps the viability of the sector. So, for example, we have the liquidity injection, that was the Atmanirbhar package in 2020. That was a 1 lakh crore package. The prototype was designed at PFC. I won't go into the example of what the prototype was. So, but that infused a lot of liquidity in the private companies, and it ensured that the discoms are paying the private companies on time. It also helped in stress asset resolution. So then that has now evolved to a new scheme called, LPS, that's late payment surcharge scheme. And so these schemes have, multiple facets. So one is the financial part where, which we give the prototyping. But then you have the ministry which says, like LPS is a notification actually, where the ministry has put in a condition that if discoms don't pay on time to the private entities, then they're, the the distribution companies would have a challenge in terms of getting power supply from other utilities. So there's a lot of policy evolution advocacy which gears up for the sector, and also we are part of the missions. So like solar is a mission, so PFC has been a key part of it. And then because we have a mandate which is more sector focused, we tend to take calls which are more how would you say, banks don't take those calls. Like we'll take a call which is more supportive essentially. And a large part of what the Indian power sector has become privatized is because of the PFC funding of private entities from the, initial stages. So we had some hiccups also, but, we have been funding the private entities since the starting, and we have kept our consistent support when there was a slight downturn, banks have pulled out of the power projects, but we haven't. We have maintained a consistent support because we are a sector focused, and we are part of the ministry. So that's the whole point. Like so we support more consistently also, and we probably are, as you rightly said, more focused. And since all of us work for a single sector, we tend to know a lot of heuristic, like learning by trial and error or learning by doing also, which doesn't necessarily come into a report. It's just that knowledge that we get as part of our DNA.
Right.
Anyhow, thank you.
Thanks. And so now the next question is to Monica. So do we expect sizable IDF investment into the sector? No.
Uh, I think as the sector is getting, IDFs will generally come when, they have a lot of expectations about the internal rate of return for the projects. So they are more focused on that area. The part is when you're saying more IDFs, I would say more maybe the InvIT kind of a structure which may keep on coming in these, as we have seen in the ham model, where the cash flows become more kind of a reliable, and they are more static in nature. In that scenario, I will say that the IFCs or the PFCs kind of organizations who are originally taking the initial risk of the during that commencement period. Thereafter, I look at it that it may be, shifting to a kind of a, where I'm saying road InvIT, there will be power InvITs, where now we have the PPAs which are controlled through the central government agencies. So they are more reliable in nature. So, and I think these kind of structures should come into the system from the perspective of, a better sharing capacity within the system to, reduce the systemic risk which may come from only a few handful kind of institutions in the entire economy. Definitely, there will be a lot of interest generated through the IDFs also now.
Okay. So we had done a poll on who is likely to finance the growth of power sector. So the initial answer obviously was it will largely be focused companies rather than the banking sector or a broad market.
So I'm also, I'm also saying that, the initial risk when the initial stages of the, operationalization of the project, that will probably continue to be through these, specialized agencies, because, besides the mandate of financing, they have a bigger mandate from the power ministry to grow the sector itself. So what Charu has said rightly, besides funding, they have a lot of, mandate and, responsibility around the policy advocacy part of it. And I would say that, we have handful of organizations within the system, 3 4 organizations to talk about: PFC, REC, IREDA, who will be basically looking at a, power finance and the need of the country, which we saw through the your presentation also. We are looking at 25 trillion kind of an investment which should come into the system in next 3 4 years. I think it's a huge demand on the financial sector to fund these projects. So definitely there should be more partners to it. And from the, risk diversification perspective, it should be handled by different kind of organization, different kind of financing, so that, each financer plays its own respective role of that risk responsibility.
Okay. Thank you. And now coming to the financing from the asset, we move to the liability side. So again, the question is to Monica only that do you recently RBI, as seen in the presentation, RBI has increased the risk weight for such NBFCs by 25 basis points, 25%. So do you see that impact of cost of funding because of that regulation?
Yes, because of that regulation, definitely there will be a, cost of capital which will be passed on through their risk rating mechanism to these IFC. But I think these IFCs still have a lot of room to, go to the bond market. And the way we are looking at the bond market in next 2 years, the rates are cooling down in that, but MCLRs of the bank will still, stay at the levels where they are, because, their tapering of the MCLRs will take little more time, because the funds they have raised, it will take time for them to taper it down. So I think it will be, besides the cost increase, which will be, kind of a 25 bips to, roughly 25 to 50 bips, what I'm looking at, which can be passed on to these NBFCs. I think it would make a lot of sense to, the institutions like PFCs and RECs who are able to tap the markets directly, at this point of time. And I think they are getting it at a very, very competitive rates right now. And it actually matches with their ALM perspective also.
Okay. So now the next question is to Charu on the same subject. So do you think that the NCD bank share, the capital market bank share, which had moved in favor of the banking sector, so will that again reverse? And will NCDs or the capital market become a
So,
larger share of the overall liability
it's a
pie?
nuanced actually response that we already have a mix which is heavily weighted anyway towards bonds, and our bank borrowing is about, I mean, it's less than 20%. The rest of it is essentially bonds, although there is also 18% of foreign currency. So so the thing is that you already have an outstanding liability of borrowing, and then every year we're doing an annual borrowing, as so to say. So within the annual borrowing, if you look at an 18% kind of uh borrowing for a bank, from the banks as RTL, then it would have only a marginal effect on our pricing and generally. So I would say this would probably also extrapolate to the sector at large. But to us, what we are seeing is in the short term to medium term, we expect, just marginal effect.
Okay. And Ankit, from the capital markets, our
Yeah.
assessment is that if we reverse back to the position of 2016-17,
Hmm.
where bond market or capital markets provided most of the funding to such companies, so
Hmm.
our estimate is that about 1.25, 1.3 lakh crores will be required
Right.
in addition to what the capital markets already funding such companies. So do you
Right.
think there is a depth of such volumes in the capital markets, or will it distort pricing structures, etc.?
So, yeah, I think just to take off from what Charu was mentioning, as of today, if you look at PFC REC combined, it will be 60-20-20 in terms of the liability mix. 60% from markets, 20% from banks, and 20% foreign borrowings. Roughly, I mean, it can be 1-2% here and there, quarter wise. If you look at that whole borrowing mix, I think it'll be about 8.5 lakh crore. Uh, at the combined level for both of these entities. Out of that, if we say we are about 60%, which is from the market, that's a sizable number already. The only thing is, if we just take out the mutual fund asset management, which is us, then that is only 10% of that. So 10% of the total borrowing, which they are doing. So about numbers suggest 92,000 crore and 74,000 crore combined. So about 1.6 lakh crore out of the 8.5 lakh crore borrowing is from the mutual fund market. So the balance, if we say, coming back to the number, 60%, which is bonds. So 60% of the 8, if I were to take, then that is about 5 lakh crore, which is bonds, out of which 1.6 lakh crore is mutual funds. So the balance, 3.4 lakh crore, is actually other long-term investors. And we are talking about pension funds, EPF, private offices, various other long-term liquidity, players. It could be investors from outside. So if you look at that pie, I mean, the access to financing can be significantly higher. If we will simply say how much room is there in the mutual fund market, I would say that these are two large borrowers, and they will continue to borrow. I think overall, I think I stated the numbers for earlier for 1.6 lakh crore. I'm sorry, I'll have to correct that. The number is actually smaller. It is only 70,000 crore in the mutual fund market. I'm very sorry for that. But the total number, then it means the numbers I stated were actually NABARD and SIDBI. 1.6 lakh crore is NABARD plus SIDBI. And today PFC REC is 70,000 crore, just in comparison. So, I mean, if you look at the financing that is coming from our market to these various financing entities which are linked to the government, of course, there is some room for this to grow further. The challenge is that it is only 10% of what they're borrowing, right? So 10% of the bond is what is being borrowed from us. The rest of it has to come from is actually coming today from other investors. And I think over there will be some scope for them to add. If you see the insurance players, if you see that's again a growing pie, which is available, for investments. So I think there is depth. It'll be difficult to say, and we'll have to wait and see how market evolves in terms of additional, because we are looking at significant investments in this sector in the next 5 to 7 years. We are looking at overall addition of capacity in excess of 400 gigawatts by 2030. That itself, I think the numbers are huge. Financing will have to come from every possible source. So I think it's not just limited to Indian lenders or Indian investors. I think it will have to come from every possible source. It'll have to come from the banks. It'll have to come from our markets. It'll have to come from pensions, EPFs. It'll have to come from foreign bond issuances. All of these sources will have to be tapped. Yeah.
Okay. So yeah, so you're saying while mutual fund industry itself may not be able to provide significantly higher sums, but all the markets put together would be able to chip in to meet the requirements, and
Yeah,
anyway, the sector demand are even far higher than that. So
yeah. I,
probably
I'll
have
I'll
to
add
go.
I'll I'll add one more point in this, Sanjay. I think we have to bring in the point that if you look at mutual fund industry in the last 1 year or so, the addition of long-term, bonds, long-term investment that has come into the bond sector, into the fixed income, has not been very high. If you see after the indexation benefit that was taken away by the last, in March 2023, the overall investment in the long-term sector, given that the returns have been that much lesser for investors to participate in fixed income. Uh, so the large participation has been seen in that 1 to 3 year kind of segment within the mutual fund industry. And as you can see, in that segment, obviously there will be some challenges when we are looking at taking long investments. So PFC, REC bonds will be long dated. They'll be 10 years, 15 years. Uh, so that can be a challenge for us in terms of being participating in these longer issuances. Um,
Okay, so you're saying overseas markets will also have to be used substantially to deploy resources in the sector, right?
yes, for sure.
Okay. Now coming to the key risk factors, so Charu, your team handles technology transition, right? So how do you see technology transition risk evolving for the sector? Because we are all across the place, like we have consumers becoming prosumers, we have the technology of green hydrogen, etc. So and electric vehicles, the works, everything is happening together, right? So whether the demand for a current project today will remain there or not itself becomes something that we need to discuss. So in view of so many moving parts, how do you see the transition technology risk evolving for the sector, and mainly more than the sector, the client, the current clients or your current borrowers?
Yes, so PFC, has been a pioneering organization from the start in, funding new technology. It's how we are geared actually. So for us, it's not a risk, it's an opportunity. And like, for instance, solar mission is a very big opportunity now for all of us. In the early days, it was an opportunity which PFC has taken up, through doing pilot, project studies and through a more detailed, because of the way our profile is, by, creating domain knowledge experts who have both the technical and the financial knowledge to devise guidelines for funding. Okay. So that head start we have, that A, we have the technical expertise, and B, we also have, I think, the courage to do new areas, which include new technology areas. So in the same sense, as the solar mission is a very great success, but over a longer period of time, I personally feel that the green hydrogen mission will also be a very great success, because when the government is in mission mode, they will support through many mechanisms. Like if you want to see the solar mission, that's also a great success. So there might be some hiccups in between, but it would be a success overall, being a mission actually. And generally, I feel that a new technology is essentially an opportunity. That's what I can say.
No, the question was more from your existing book, where you have significant exposures and very, very large exposure to generating companies and distributing companies. So how
Yeah.
do you see them? Because the demand at the margins may go down, or they may have to compete in the market for certain pricing. So how do you see it impacting them?
So you're asking about like power sale by generation companies on the power
Yeah, so
exchange?
the pricing for generating companies, the pricing for distribution companies, the demand for generating companies, because
So,
we have a lot
this
of
is
different actors,
also
sector
part of the
activity.
sector evolution. So, power sector, we really have to see it from an evolution perspective. So, one evolution that the government did, which I mentioned, was the privatization. From a monopoly structure, we now have a competitive structure. And the second evolution was that from PPA, now you also have a market. Now, it's a market. It's obviously not going to be regulated like a PPA by an ERC, or, and it's an open market. But since the demand for power is growing, so there would be, attractive prices, and the prices have been shooting up like 7 rupees, and in fact, there's a circuit breaker at 20, as as much as I know. So I don't particularly. So the thing is that the pricing on the market would vary, but there are many surge pricing, and with the input of renewable energy, there would again be a demand in the evening peak. So the evening peak would not be met by renewable energy, at least not by solar. So you would have a price surge in the evening peak also for some time. And what was I going to say? Just a moment, let me come back to my thoughts around this. Yes, so the only concern I feel is that while the prices can be very attractive, the market is still, developing depth. And any business model has to see how much of million units you are selling vis-a-vis what is the market capacity to absorb the million units. So a very large project would be I mean, generally quite large projects do have PPS, and there's a balance part which is available on the exchange. That's a good business model actually.
Coming to in I think Ankit, with rising share of private sector in the overall mix of disbursement, mainly due to the renewable which is coming up, do you expect the portfolio, because right now we had a much more structured manner where government was the borrower, government was the lender, government was the financer. So from there to go to a market where, in fact, now we are talking that of even markets not be even TPS not being there, markets have to find the routes, etc. So how do you expect the portfolio vulnerability of these companies to move in such cases?
Right. I think interesting question, Sanjay. I think private sector, if you go back 10 years, 15 years back, I think it was always seen that, it was the private sector which has, and even if you look at PFC REC's unrealized past dues, it is all private sectors, right? 87% of PFC REC is exposure to government entities, and all of them are stage 3-0. Whatever is the stage 3 sitting on their balance sheet is actually private exposures. Having said that, this time around, I think things are different. If we look at whatever has been the new projects that are being taken up, a very significant portion, and I will say this borders above 90%, is those projects which are being taken up by private players, which are backed by really very proper tight PPAs. We are not seeing financing this time around, which is basically riding on the fact that India is power surplus and power deficit, and it will always remain that way, and there will always be demand for power in the open market. So essentially, what tends to then happen is that this whole risk transfers to the counterparties, right? So the moment you have PPAs backing private projects, the actual risk is execution risk. So the key risk then will be private players. If they are small players, they don't have the background, they don't have the ability to execute and complete power projects. Those will be the ones where there might be a chance of them, becoming having challenges ultimately. But once the projects commission, whether it is private player or it is a government executing those projects, I mean, it's PPA backed and the counterparties are discoms. So indirectly, the risk passes on to discoms. And then we have to talk about discoms, because discoms is not a simple subject again. So as long as there is demand, the discoms need power, and there are supportive government policies like the LPS or RDSS, which are essentially trying to improve the power sector. I mean, look at LPS. What it did is that it tried to manage the finances of the discoms, which had been facing challenges, in the past, and there were large overdues. So try to clean up the system. Look at RDSS. It is something that is trying to bring down AT&C losses. And we've already started seeing some results of this. So if Discom health improves over the years, while we are pushing that 6.5 lakh crore Discom debt down the lane, because it's difficult for them to continue repaying, servicing interest itself is a challenge as of now. But if eventually, as tariff hikes take place and as AT&C losses reduce on account of schemes like RDSS and all the other measures that Discoms take to improve their efficiencies. Uh, I think at some stage we will see a situation where we will actually see that Discom debt level actually going down. I am hopeful it will happen soon. This is digressing a little bit, but coming back to the main subject, I think whether it is private players in the past, a lot of private players face challenges because Discoms delayed. Okay. A lot of
Yes.
generation private players face challenges because they couldn't execute the projects. A lot of another challenge is also availability of coal linkage and supply of coal in a timely manner. There are several projects which went under because of coal supply not being available in time, approvals not being given on time, infrastructure for evacuation of power not being ready on time. So I
Ankit,
think.
Ankit, I would like to stop with my. I think as a in this webinar, the question for us from the answer we expect from you as the
Hmm,
participant or the
hmm,
financiers for
hmm,
these
hmm.
agencies is that if the private sector moves to, let's say, a 50% share, whatever be the underlying ground condition or change condition that you've discussed,
Hmm.
do you think that the pricing will remain where it is, or there may be a change in the risk premium?
Oh, you're talking about the lending. Uh,
Yeah, the bond
Okay.
market, yeah, from the bond market.
Okay. Okay. Yeah. I think if private sector increases, then obviously the expectation will be a bit more in terms of the risk return over there. And that is because we don't have government guarantees and other, supporting uh, things in terms of the financing done to the private sector. So I believe if it goes to that higher number, uh, gradually you will see increasing pricing, and that is to factor in that additional risk that comes in. Yes.
Okay. And
Sorry, sorry for going into a very different
no, so
tangent.
that was also needed for this conversation. The background was needed, so thank you for
Sure,
that.
sure.
And Monica, for with Powers, IFCs contributing one-fourth of the bank sector exposure to NBFCs. In fact, RBI has also pointed out that due to this, the banks have been taking significant risk on the indirectly through the power sector, NBFC, the two large generation companies and distribution companies, right? It's been flagged off in the trends and progress. So, do you see that the concentration risk being a very material sort of a concern, or how do you view that
So you're talking from the banking sector perspective.
from the banking sector perspective? On that, one-fourth of their NBFC exposure being towards the power sector NBFC,
Yeah.
and the banking sector itself having a very large exposure to the NBFCs itself.
Yes. So, what how I would take this question is like, if we look at the overall NBFC exposure of the banking sector, that's somewhere around 15% of the overall book. Within that 15%, I'm talking about one fourth to the power sector or the power sector NBFCs. So, number one, the health itself of the power sector NBFCs has improved considerably over a period of time. A few of the things I think Ankit mentioned how, and Charu also mentioned. But along with that, we'll have to see the major reason is not only the commencement of that or the operationalization of the project. That is, now we are getting all the private equity investors who are coming into the sector and kind of operate commencing these businesses, that they, along with the equity, they also bring the technical expertise to it. So the commencement risk what we were seeing in the sector, it has already been kind of curtailed down. With respect to the efficiencies of collection mechanism, we are already seeing a change which is coming through the smart meter technology adoptions and all. So we are looking at very very positive scenario. We have already seen the PPA which is coming through the discoms, where we are already seeing the price change in the peak and the non peak hours. So those are some of the risk mitigants around how we are looking at the power sector now. And as I said, many of the things come for a refinance also after the PFC. The PFC has taken the entire risk of commercialization of a particular project, but then after that it comes to me for a refinance. I think I'm good at it. I should not be unduly worried about these factors. But at the same time, we need to look at that, the reforms which have come into the power sector in the last say are about 7 years or so. Those are really really important differences, and going forward, I think this is one sector which will always remain in focus. As of now also, we look at 85% of the power sector expenditure which has to come, whether it comes through PFC or REC or any other organization. It In the power sector, it comes to the government itself. So it's actually the exposure the banks are taking in the government. So I mean, we are not looking at a scenario in India where we are looking at the government AAA rated organization is going to not be handled in a proper manner.
So, so ultimately, a lot of comfort comes from the government ecosystem which is there. So
Absolutely.
like Ankit said, once private becomes much larger, because incidentally the banking sector exposure to power sector itself is about 6%, which is so it's almost equal to the exposure banking sector has on the power focused NBFC. So that is
That's
what
true.
how that is
And
how
it is going to increase.
It's a
That's what I'm
large
saying.
part
If
of
it
your
comes,
capital
it's
asset
going to,
also.
yeah. And the way any industry, so we would have seen the hams in the earlier years. We used to look at in the same manner with respect to the road sector, but the ham just changed the but game altogether. Similarly, for the power sector, when we're looking at PPAs which are coming from SECI, so it is a pool of the entire cash flows which they are generating at one place, and then it is the pool which is actually working as a risk mitigant. I think Care would will be able to assess us better than me, but then it's actually diversifying our risk to various projects. It's a pool which is I mean, the authenticity and the availability of the money at the right point of time to the bankers is no longer that big a challenge. And even if I look at the C&I segment, as Charu said, that it's not only that central agencies which are coming for PPA around. There are very C&I customers also. Those C&I customers, if I look at even the data centers coming to the system, where Amazon, the Googles are kind of taking care as a C&I segment. I think they are huge multinationals. They are AAA rated or a AA rated corporates which are taking. I think from the perspective of repayment to the banks, I think we are in a healthy position right now.
So if I heard you right, you are saying like as a banking sector, you are saying that hey, we are coming, don't underestimate us in the power
Absolutely.
finance.
And it will be, Sanjay, it's not that we are coming. I think it will be required, because even if I look at, the incremental growth which may come from the, insurance companies, which Ankit talked about, many of the bond funding is done through the insurance companies to these sectors. 15% we all know insurance companies have to, invest in the infra sector. So if I look at the growth which is coming up in the insurance sector, which is around roughly around 10% incremental AUM every year. So it would the number of bond issuances which are happening in this infra sector is not enough to take care of that gap. So we still have space there.
Okay, so you're saying significant infrastructure funding can happen even through insurance companies and similarly from other such sectors who are.
Definitely. And when we look at, when we hear many of the multinationals or the, multilateral development organizations, they are saying they are, their ESG funds or the climate related funds are waiting for investment in India. They are looking at India at a very big market for them. So specifically, if we say our power sector is, growing through that renewable space, which directly, in any of the taxonomy you took, it comes in that particular category of green, a very dark green color. So those fundings are also waiting to come into India. It's only that we need the organizations like NaBFID and PFC kind of organization to channelize it to the right place.
So while the sector needs a lot of fund, 24 to 25 trillion rupees in the next 5 to 7 years, but a lot of funding is available. So pricing probably is something that will play a important part in the whole thing, because the risk will be distributed according to the pricing. And
Yes.
then each of the entities will have to fend for itself on where do they stand in the pricing structure, and accordingly they'll have to find where do they find themselves on the risk structure. So yeah, that's a very interesting
That's an
observation.
interesting thing. I think pricing perspective, if you look at, the PPAs and all, the wherever there is a, very aggressive kind of a bidding, obviously none of the banker is going to be very much, jumping on the curve and, giving them the funding unless they are bringing their equity on table. So it's basically a risk mitigant which works very in a very healthy manner. I think bankers have learned the lessons in the earlier cycle of infrastructure. I think they are also from the perspective of understanding of the sector, and from the perspective of how to assess the project and to the monitoring mechanism. It's all becoming more healthier day by day.
And
I want to say I agree with Monica regarding that across the loan life cycle, we are all building expertise, and monitoring is also very important, as Monica has mentioned. Very true.
And so we, again, a question for you, Charu, that we have seen one of the panelists say that if you move towards the private sector, then your costs may increase. We have also heard in the discussion that given the RBI norms on NBFCs, especially rated AAA and AA and all that, the pricing could increase there also. And we in the presentation also we heard that a lot of the private players would contribute towards the new generation, etc. So where do you see your profitability with this changing, let's say, mix and the new players coming in, etc.? So on one hand, you could have pressure on the pricing from the borrowing side, whereas on the lending side, a lot of this could go to InvITs or to banks or to insurance companies or to overseas fund. So where do you see yourself in this market?
So I'll have to gaze at my crystal ball and get an answer for this. But anyhow, you know what? Like there are two sides to it, as you've yourself mentioned. So one part is about, essentially like boundless opportunities for growth. And one area is a renewable where, 50 gigawatt per annum, or if you want to talk in terms of lakh crores of figures that we are looking at, is like it's more than 31 lakh crores of investment requirement across conventional and renewable. And more of it, of course, is for the renewable, about 26 lakh crores. That's the figure our annual, presentation has. So there's a huge investment and, of course, a lending opportunity out here. And there is also a very large opportunity for funding distribution, because it's see, the way it is that we see it very positively that we are funding the distribution companies to become more profitable. And so for that, we have the RDSS scheme. That's more than a 3 lakh crore scheme, in which PFC is, of course, looking to fund, huge amount of it. And then there is LPS, which is, there's already, I think, disbursement funding of more than 1 lakh crores. So these are very large government schemes. They also act as growth drivers. And we also not only, of course, fund it, we also monitor the scheme. We also give inputs for designing the scheme. So there's a very, as you said yourself, there's a very big ecosystem. And I mean, we don't see that the whole funding will shift to private. Actually, we're not seeing it, at least not in the short term to medium term. We'll continue to have a large, part of the government entities, primarily discoms, also getting a lot of funding under various government schemes. And then, of course, renewable is a very important growth area as well. So that's the large, the large what potential for funding, and which would, of course, lead to profit. And then on the other side, we have concerns about the cost, and especially concerns that arise from the latest RBI, regulations. Uh, but as I mentioned, our borrowing from banks is just about 18 to 20%. So it's not the majority part actually of our borrowing program, no? It's actually the minority or whatever. Like it's actually the smaller chunk. And as Ankit had mentioned, there are many, evolving instruments. And as Monica ma'am also mentioned, there's also a lot of support from sovereign wealth funds and so many other, foreign institutions towards green funding. So new instruments would evolve, and it's very highly evolving. I mean, we have a very positive, we find the future very like bright for
So,
India also.
so you say that while we may keep discussing the sector a lot, but in the short to medium term, it is going to be a lot more government and it's going to be a lot more policy driven. So to that extent, the entities are well, let's say, placed in terms of both funding as well as the profitability. Okay, so we
See, I
come
can't, I mean, I don't have a crystal ball. I can give you my views for and
correct, correct.
against.
So we are basically
I
looking at the
wouldn't
crystal ball,
want to,
not looking at the crystal ball.
I would
I,
say that there are two sides of it. We can look at both the sides.
Okay,
See, there could
I,
always be a force major, I mean, it's very difficult to predict anything. So if
okay,
there's a force major or there's some new government regulation, some new provisioning norms, anything, RBI, uh, so it's not possible to really predict. But
okay.
the growth drivers for the power FIs are very good. And also, I want to close with, that while PFC is known for funding power projects, we have now expanded into funding infrastructure
So we
projects,
are
which
looking at the power sector only. So we are not discussing PFC as a projection
okay,
for
but we are
itself.
doing it.
So
So that also has
if yeah,
effect
I
on
would
our
like to move over to Ankit.
profitability.
No, I would not like to continue on that discussion.
Oh,
Okay, Ankit, you have
okay,
please
fair
take it.
enough.
yeah, I just wanted to add a small point. So, like Charu was saying, access to funding. I think your whole question is around the possibility of increase in cost for PFC REC going forward because there will be higher exposure to private sector. I think if you look at private sector investments by these entities in the so I think it was always the generation which had challenges. It was thermal generation which had long execution periods. If you look at now the private investments, a lot of it is coming in transmission. A lot of it is coming in distribution. The new discoms, various licenses, additional capex which is done, improvement capex that is done. A lot of it is regulated capex, right? And once the project is completed, the project execution period is also lower on the renewable generation side compared to the thermal side. So overall, if I see the whole sector's the way of working when it comes to the timeline of completion of project, there was always execution risk, which was a challenge. Uh, the counterparty risk we discussed, since all of them are backed by either SECI PPAs or some of the C&I PPAs are also okay. So the discoms are state discoms are also paying on time. So it is not it won't be because of that exposure going to private is what my sense it will be how much access to financing PFC REC is able to generate by way of this of this authority in power sector and being able to project itself and being able to garner larger base of lenders which it has done fairly well till now. uh, just to give you an idea from the market today, the numbers I was mentioning, NaBFID, SIDBI, they're also government organizations. They're also funding projects. They're also backed by a lot of guarantees and other structural features. Their pricing in the market is higher than PFC REC. And the reason is not because of their mix when it comes to their on lending, because to some extent it is, but also because of the quantum that they are borrowing and the limits that all of us can actually give to them. So the more access you have, the more people that can lend to you, and the more limits you have opened from various sources, foreign, domestic, banks, bonds, the more better pricing that it can have. And I think that is the thing that we'll have to see and watch out.
Correct. So final question to Monica. So we look at the risk you discussed of various risks the banking sector has seen over the years. So what are the other key risks facing the sector? So incidentally, there have been quite a few questions from the audience, but almost all of them are pretty related to PFC as a company. So we not like to take that up because one is we don't have appropriate management representation from PFC for such thing, nor is the forum to discuss PFC's operation. So we not like to take that up. So we'll take up this final question and that what are the other risks facing the sector and what change do we see in this growth cycle which was not there, which could lead to the asset quality stress? So from a negative sense, what change do we see in this growth cycle? So while we have talked a lot about the positive changes, in the negative sense, what
Huh.
could change?
So I will restrict my answer only to the power sector because we are talking on the power
Power
only.
sector.
So I'll not take up other sectors of infra which have other things. But what I look at is one is the module manufacturing, which is we are talking about in a big way that the solar is going to become a big thing. So the in the past, just 3 years back, we had seen the module pricing has a very negative impact on us. While we have put up our internal policies in place with respect to the country that will give the clear land title and will create entire infrastructure and ring fencing of the cash flows and the better counterparties for PPA. But this module manufacturing is still not our India based thing. It is still based outside India. The other thing which I'm looking at is it is a peak and the non-peak kind of a supply, where we are talking about that we need to innovate with respect to the storage capacity. Whether we talk about wind or solar, we are looking at those storage capacities. So those storage capacities are right now in the evolution stage, where we are saying there will be a lot of technological advancements which may come up. So if something has been done today and we have funded it, so maybe tomorrow a better technology may come up and which can reduce the cost. And as you were saying, then there may be a challenge on that particular project. Third, when we are looking at wind capacity, when we look at, so wind is actually not a very stabilized or tested model as compared to the solar. So wind has its own challenges, and we are still looking at how the PLFs are going to fix around these wind projects. So wind is again, now hybrid is the talk of the day, and we are coming up with hybrid projects. So wind is still not a stable thing which we have seen. So these are the few kind of risks which come to my mind while we are assessing these power projects.
Right. So we started with the discussion that there's a lot of transition happening in the power sector from the business perspective. Probably we are ending the discussion where we are saying that a lot of transition is happening in the power sector from the liability perspective also. So there would be interesting times. The organization that we're talking about has stood very robustly, as Ankit pointed out. From in the late 90s, where the initial reform started, today we have gone a long way. Probably some more distance has to be covered, but we have this organization solidly supported by government, etc. So I think while times will be interesting, but I think things will still be very reasonably safe and secure as we go ahead. So with that, I thank you all the panelists, Monika, Charu, and Ankit, for sharing such insightful thoughts in this discussion. And like to hand the proceedings back to Divya. So Divya, you may take over.
Thank you for inviting us.
Thank you.
Thank you, Sanjay, for moderating the session, and Neha for your presentation. Once again, thanking all our guest speakers for their insightful views. It was a privilege to host you. And lastly, thank you to all the participants for taking the time out and being part of this CareEdge webinar. For any further queries, feedback, or suggestion, please write to us in the feedback email. Goodbye for now, and requesting the tech team to kindly log off.
Thank you.